Welcome back, everybody. We're welcoming back to the show Ellie Perlman, who's been on a number of times before. She leads the firm called Blue Lake Capital. And Ellie, we're happy to have you back on the show with us, again today. We were joking right before we went on air that we don't know what breaks are because here it is spring break. The world's on spring break, but you and me, we drew the short straw. We had to stay in the office, apparently.
Yeah, no breaks for us. In fact, I was actually stuck in traffic. Believe it or not, I live in LA and my commute is not terrible. So it's about 25 minutes each way. And today it took me almost 45 minutes. And now I understand why. Everyone is on spring break. So everyone was driving somewhere with their kids. I guess that's what happened. But yeah, don't know what that word means.
No, not at all. Me either. It's going to be a while before we get a break in the action here, but that's the way every year starts off. Ellie, I wanted to ask you from a multifamily perspective, what sort of diligence are you guys going through? When you are looking at multifamily acquisitions, and has it changed from a couple of years ago when it was a little bit easier to borrow money at a better interest rate, and how has it changed? Fast forward to what we're doing right now, borrowing at much higher rates.
Yeah, it's a really good question. In terms of the due diligence, we're not doing anything differently per se. So it's the same 30-day due diligence period we have. Every time we're under contract, we actually send the team to the asset to walk every unit, and go over all the documentations regarding the tenants and review everything from the construction standpoint. So the process is still the same. And usually we hire a third-party company that is helping with that as well, and we oversee that, of course. But really, what has changed today is that it's not the process, but the fact that we're putting a lot more emphasis on the tenant base and looking at their profiles to make sure that there's not going to be any issues with delinquencies or bad debt, collections. That has to be very strong
Interesting.
across the board.
Yeah, so you're digging into actual applications and resident screening profiles and all of that now.
Yeah. Well,
That's
it's something that we've done before. It's just it's something that we put more emphasis on, and we're not willing to take the risk anymore and say, you know what, maybe the tenant base is not as strong. We can work, with a property management company after we buy the asset to clean it up, and to increase the profile of the tenant base. Um, it's essentially something that we are putting more attention to. But it doesn't mean that the process has changed. It's just the emphasis on certain data points in the due diligence process is a bit different today.
that makes sense. What about market analysis? So diligence is one thing, I guess, once you get a property in LOI or under contract, and then you kind of jump into the diligence items. But what from a market analysis standpoint, what are the things that you encourage your team to do as you're looking across the country for acquisitions?
Yeah, a few years ago, we were focused on a handful of markets where we saw a tremendous growth when it comes to internal migration within the US and also growth in rent. And right now, we're looking at not the entire US, but at more markets that we may have overlooked, 2 and 3 years ago, because really what is important to us is to buy in strong locations. And I don't want to be, limited to a handful of markets. It means that you need to invest more time and resources and energy into learning more markets very well, because you want to make sure that you are buying in the right market, in the right sub-market. For instance, I can tell you that in 2019, Jacksonville was a desirable market for us, and we bought assets there. And since then, we've exited those deals, and Jacksonville is not on our radar anymore. We're not looking at Jacksonville right now, because we haven't seen the growth that we thought we could see. So we exited.
Gotcha.
We made a nice profit, but on the assets that we sold in that market. But things change all the time. You can't just stay married to certain number of markets or one market and just buy and sell in that market alone. You can, if the market gets better or stays strong, But the reality is that in real estate, markets do change and things do change,
Yep.
all the time. So we adjust our strategy based on what is happening in the market.
So it's population growth. Is it GDP growth? Is it, the number of elementary school permits that get pulled? Like, what are some of those like, kind of granular items that you guys would be looking at?
Usually, I would say it's population growth, and because we don't want to invest in a market where people are leaving,
Yep.
that means that the demand for multifamily is going to be lower. Um, so it's population growth, it's job growth as well, and rent growth. These are the main three things we're looking at. And of course, we're also looking at crime. We want to make sure that there's no crime where we're buying assets, but the growth is what's fueling the demand for multifamily. If people are moving to a certain markets, if companies are moving to those markets and they open more, they're hiring more people and there are more jobs. And because of those two factors, the demand is increasing and hence the increase in rental rates. These are the three, that's kind of the three items, the three point of data that we're looking for
Mm.
in order to establish whether those markets are going to be strong. One other thing we did at Blue, we looked at the last 2 to 3 recessions and we analyzed which markets maintained relative strong, good value
Mm.
through the recession and coming out of those recessions. So,
Yep.
every recession is different, obviously. But this really helped us understanding, okay, if there's another recession, which seems, we don't know what the Feds are going to do. It looks like, soft landing. I don't know what's going to happen, obviously, but I do think that there's not going to be a major recession in real estate, and if there is going to be a lot more pain, it's pretty much going to come from office and retail,
Yep.
not so much from multifamily. Um, and so, knowing all of that, we can say that, hey, based on the last several recessions, these are the markets that actually fared well. So they're more likely to maintain values if we invest with them today, whether we hit a recession or not. And we will, it's just a
Makes
matter of
sense.
time. I just don't think it's around the corner.
Not to get, off topic on markets a little bit, but do you see any contagion spill over from, the office issues into multifamily at all?
Yeah, some investors have invested in both, retail, office, multifamily, and so they are experiencing some liquidity issues on the office side, which prevents them from, investing in new assets, new multifamily assets. That's one thing. Another impact that I see is from the lending side. So we see lenders getting a bit more nervous and becoming more strict with their demands.
Hmm.
And it's partially, I believe, because they not only lend to multifamily but also to retail and office, and more office assets are not performing well, and so that puts pressure on the lender and their liquidity. And Powell's that mentioned last week that he believed that there are going to be several banks that are going to fail. And he's not talking about Bank of
Hmm.
America or JP Morgan. He's talking about those regional and local banks
Yep.
that are lending a lot of money and have a lot of exposure. They're probably going to feel a lot of pain from the office side. And so we feel since January of this year um, that they are becoming more nervous
Hmm.
and they're becoming more strict with their demands, even for assets that are paying the debt, and there's no issue there because they're experiencing a lot of pain from the retail and the office, side.
Really interesting. On the the market side, switching gears back to that for a minute. This is not a political question at all, but there's clearly been a lot of immigration into the United States. Some people say 7 million people over the last 3+ years, and I'm just curious. I see that as a tailwind in single family rental investments, and I think a lot of people do. Do you see that immigration to the United States as a tailwind in the multifamily world?
It really depends on the market. Some markets are more sensitive to it, and depends on the concentration
Mhm.
of markets that have more immigrants. I would say that some of them tend to concentrate around Class C assets and blue collar workers. During COVID, they got hit pretty hard because a lot of them that were working in the service industry, found themselves out of job, and
Yep.
so that's the impact. During at least during COVID. Um, right now, I don't see a major impact, but I hire, people that are much smarter than me, at Blue Lake, and they could probably answer this question in a more intelligent way. Um, but we don't see a major impact, at least not in the assets that we're looking at. We're looking at stronger assets, Class B, Class A, and
Yep.
usually there are not a lot of immigrants in those assets.
Workforce housing, not as big of a focus for you guys.
Yeah, correct.
Well, I appreciate the time, Ellie. We've got a couple of minutes left, and it's always really interesting to see, your perspective on, how these things develop over time. Multifamily. One last question. A lot of people say in a bunch of different markets around the country that it's gotten a little bit overbuilt. Do you feel like that in certain markets? Are you avoiding certain markets because of that development?
Yeah, there's certain markets are definitely overbuilt. Part of the due diligence process before we chase a deal is to look at the new construction in a certain area, but then also it's important to understand when their lease up is about to end, and that's a very
Interesting.
big distinction because if you have, say, 1,000 units within half a mile from an asset you're thinking to purchase and it's under construction and it will be complete in a year, then you can expect in a year to have some issues with raising rents because those new 1,000 new units are going to cut rates and compete with you, and they are the new kid on the block. They have the best amenities, and but some markets have essentially completed the lease up period,
Yep.
and the delta between their rents and your rents are such that they're not competing essentially for the same tenant. Sometimes they will. You gotta be careful there, but sometimes they don't. And then in that case, they're actually increasing the value of your asset because it improves the area in general. So a five, six, $700 delta in rents between those properties, you're not going after the same renter, and it's actually improving the value of your property because the neighborhood is nicer, it's newer, it attracts better people. So it goes either way. It's a double-edged sword. And you just need to do a lot of due diligence and understand where you're, with eyes wide open, what
Yep.
you're buying.
Well, look, everybody, the Blue Lake Capital story is one worth following. Ellie, are you guys on social media? The viewers can tune in and keep up with you.
Yeah, absolutely. So whether you look for Ellie Perlman, which is my name, or Blue Lake Capital, you can find us pretty much everywhere: LinkedIn, Twitter, Facebook, and of course you can go to our website, bluelake-capital.com.
Awesome. Well, until we see you again, Ellie, hopefully sometime soon. Enjoy the rest of your spring break working.
Yeah, I know. Enjoy the non-break break. Thank you. You too then.
Exactly. Thanks so much. See you later. We'll be right back.
Bye. All right.